So welcome back, guys. It's a weekend. I'm going to be looking at what went through on Friday, how Friday's trading went by. So here we're having the 1 minute time frame of the Nasdaq futures, the December contract or the Christmas contract. So as you can see, let me make it a little bit bigger. So as you can see, what you all know we look for when we are starting our trading. First and foremost, I need the 12 a.m. to 12:30 opening range. So I have my 12 a.m. 12:30 opening range, and my trading for the New York session starts at 7, which is the pre-session before 9:30 going into 9:30. So 7 a.m. 8 a.m. going into 9:30. So 7 a.m. opens up. You know the model I love most, which is the optimal trade entry, the inversion of it. So we have a drop before 7, we have a low formed right there. Now I have, as I said, our breaker. So have this. So I expect my breaker to start from this low to this high, then a drop lower and a move lower. So that is it. 7 a.m. opens up, we rally higher into 12 a.m. 12:30 opening range. We fail to hit consequent encroachment of that, showing what? Bearishness. We have a volume imbalance right there, but I would first use my fib. I would first want to use my fib from that high to the low. So as you can see, we said we need a closure, we need the market to rally above these optimal trade entry levels, then we need a closure back below them as an inversion, and then the market retesting into them. So we have this massive fair value gap right here, but how far in this fair value gap can the market retest into? We have our fib levels and the 0.705 being our sweet spot. So I expect the market to come back and have a reduction from that. So your entry would be something of this sort. I know a lot of you are begging for me to show you executions, but I'm going to be doing that live. I have to set up a little bit of things for the lives. I didn't intend on making YouTube in my trading career. So we have lows right here. We have this low and this low higher than this low. So this is sell side liquidity. I wouldn't consider this low because its liquidity was taken out by this. So I'm considering this and that. Have sell side. Market drops lower into that. You understand? So the price leg that formed that, how far can the market go below that? From that high to the low. If I'm to say the extrapolations, we have the 0.25 level, as you can see right there, to the tick. It is smashed to the tick. So this is setting take profits to the tick. So that's how far the market can go below this low. I drop lower into that. So this would be my final take profit for the runners, just like that. Yeah, that's it. So I wouldn't target the low itself, I would target the 0.25 level, and it aligns with this order block right here, this consolidation right there. So if you didn't take the fib entry, going back into pure ICT, the smart money concepts, I have a volume imbalance right there from that candle's high, that candle's close, to this candle's open. So this is a volume imbalance right there. That is a volume imbalance. We have this from this candle's high to to that candle's low. This is a fair value gap. It was inversed, but in this inversion fair value gap, I'm having a price point which my eyes get pulled to, and this is the volume imbalance. So I'm executing at the volume imbalance, not at the low of this. Now this helps you get executions that are so accurate. If you induce these things into your trading and looking deeper into market structure, it gives you a bigger insight, and you're so accurate. So those guys you see who top tick and bottom tick mainly use this concept. So if I can show you something so simple, if I'm to draw my fib on this inversion fair value gap right there, from the low to that open, I'm drawing quads on that. See how the body is respect the 0.25. I'm not looking at the 0 level, I'm looking at the 0.25. The body is respect that. Now this is not random. You're going to see someone taking this entry with this stop loss at this high, so something of this sort. If someone traded at that low and that quadrant level, and this stop loss is above that high, you're going to see someone having a tight stop loss, a very tight stop loss, and you will be induced into their courses, the courses they are selling. But it's something so simple. So if you can get to use these fib levels, you have, it will put you somewhere in your trading. So we have that for 7 a.m. trading. We'll drop lower, going into the low we talked about. After that low, remember we had an order block right there. So this order block gives us a move higher. Remember, we have external range liquidity. This we have to come back into internal range liquidity. So where do I have my liquidity? I'm having a fair value gap right here. I'm having a breaker. In this fair value gap, I'm no longer considering from this candle's high to this candle's low, because this was filled. I'm looking for the area that wasn't filled. So before, I had my fair value gap marked like this as my bearish fair value gap, like that. But the market went on and filled almost 3/4 of this move. So the remaining portion is this. Now I'm not looking at this, I'm looking at only that. Now as you can see right here, the consequent encroachment of this remaining portion of the fair value gap gets respected, the candle bodies. This was volume, that's why you had manipulation above it. This was volume, and you can see the market corrected using a what? A volume imbalance. So this is a correction. We drop lower, and the market initiates its move below consequent encroachment of this remaining portion of the fair value gap, and we drop lower. So if you can get yourself to look deeper into market structure, you have an ease in building your edge. So it helps you get more accurate and also have better discipline. So if someone was aggressive at this low, and you expected it to come all the way above this, so this gives you a tighter stop loss, because my stop loss right there is above, either above this candle's high or half of this candle's wick right there. But I'm expecting, because I'm having a breaker right here, you might not be seeing it, but this is a breaker, bearish breaker block. So I'm having a bearish breaker right there, and this bearish breaker happens to align with the consequent encroachment of this remaining portion. So I'm expecting the market to react mostly at this. I'm not expecting the market to close above this. I'm expecting this to have a lot of bearishness towards price. Sorry, I don't know, I just woke up, I'm stammering. But anyway, so we rally back up into this unfilled portion, and our breaker will drop lower again. So I'm having a breaker block right there, going into 8 a.m. trading, having another breaker right there. But if you have a wick with your breaker like this, most of the times we are looking at these wicks as the mitigation blocks. You understand? So if I'm to look not at the breaker, so this is one thing that can make your breaker fail or make price not come back into your breaker and you miss an entry. So if you have a wick to your breaker, you're looking at the wick, not the breaker itself. So this wick will drop lower, closing below half of it. Then the market opens up, we come back higher into the upper portion of that, then we drop lower. We just continue dropping lower, going into what? 8 a.m. Now 8 a.m. opens up. I'm having a low. The low of this candle gives me a high, a lower low. So this is my expected breaker from that candle's high to this candle's low, using my optimal trade entry. Sorry, that's a chart of ES. If I'm to reverse this, okay, my optimal trade entry, 8 a.m. opens up. We had rallied above that. If I'm to remove this line, we have this drop from this candle's high to this candle's low. We rally above this, we close above these fib levels, we drop back into the 0.79. so this is my entry and my stop losses there. We rally higher into taking out this low. So this thing happens all the time. It's about you to know when to use it and when not to use it. So we have the market hitting the 0 level. So this is your first take profit, because this is the market giving you this move itself. So this is for scalpers. It took this. The market failed to reach our second level. It retested into this week, and we had started a sell delivery. So we drop lower and we happen to close back below this. So you know this is going to fail. The moment we close, you're out either at break even or at stop loss. So when this inverses, you know now we are continuing lower. So you're looking for your model again. What is holding the market this week right here? This week we drop from that, we rally back up into, have a volume imbalance right there, and another week we drop lower. So 8 a.m. is a bit tricky, but you know we are continuing lower. But looking into this, I'm having a new day opening gap below price, and looking above price we have nothing. So I am not expecting long-term buys. I'm looking for short-term buys and long-term sells, if you understand me. So we drop lower, coming into the new day opening gap, which pushes us higher, going into 9:30 trading. So 9:30 opens up. Now we are in these times of the days where 9:30 is not going straight to the take profit levels. We are having 9:30 first manipulating, then we drop lower. If you have been cautious about that. Now 9:30 opens up. I'm looking for my top. I'm not looking at any liquidity level. I'm looking at only that 9:30. At 9:30, I'm looking for my opening range. Now I have my opening range at above 9:30. So I expect the market to refer to that. We rally higher, not giving an entry for any buys or sells. So there is no confirmation to this. If you see the market starting to taking out highs but without body closures, we get these big drops to induce people into selling. You are not trying to be a participant in this, because you expect the market to continue manipulating. So the market fails every time to reach the 12 a.m. opening range, and as you can see, this is a trap. So we fail again, the market rallies back into that. Now the moment the market reaches this, it's the start of our move. It initiates our move. So now here, what am I looking at? We reached 12 a.m. opening range, we have a high. So if I'm to draw quads on this, the market fails to reach the 0.25, showing a more bearish intent. After that, I'm waiting for a confirmation. Now what is my confirmation? A drop lower. And as I said, that what can make the market fail to come back to give you an entry is if you have a week with your breaker block. Now I'm considering to take an entry at this week's low, the moment the market closes below this. If we were to respect this breaker, the market would have closed around near this area, but we dropped lower, and this is a signature in price that the market is going to be using this week for lower prices. Now I'm executing at this week low contracts just in case we come back into that, but my stops are above the breaker initially. Now we drop lower going into this. Now this would be a breaker for the fractal, the lower time frame, and we have this for the higher time frame, this black candle right here. If I'm to extend this into price just like that, that black candle, so we drop and close, the market drops from this week. So this would be my execution right here, my stop loss above that, and looking for lower prices. What's my first rule on liquidity? Now this is the 12 a.m. opening range for Thursday's trading, and I'm seeing it in proximity, so I'm looking at this as a take profit level, if you understand. So I'm having this candle, this would be the breaker on the higher time frame, and the market happens to close below. This is a sign of induced sales. So you can see this move, the market rejects from the 0.25, but it is pressed down into closing below the half of this. So I'm expecting this half to have what? Rejection. So we rally back above into that zero, the upper quadrant, we continue dropping lower. So these are all signs, and this is how to deal with crazy price action. You have to be so cautious and to the tick. If you cannot do that, you kindly step away from the charts and save yourself from harm, because this price action can make you cry. Now imagine you sold right here from this, we drop lower, then you sold, the market takes you up instantly, we have this big drop, you're afraid to miss, you sell from this, you think this is a breaker, the market doesn't even give you a chance of setting break even, you're stopped out again. Now this is hectic. The moment you reach the right move, you're going to be afraid of taking the entry because you have taken bad trades right here. If you use patience and you wait for your model to work out, so right here I would, if I was dealing with this, I'm having an obvious price run right here, I would wait for the market to go above this. The market going above this, let me remove this. The market going above this, I would expect my breaker to be from this low going into this high. Now if I'm to set a remote trade entry, oh fuck, let me first reverse this. Okay, so if I was to set that, as you can see, the market goes above the high, we drop lower, we do not have a retracement, but the market comes back hard. and on top of that we haven't reached the 12 a.m. opening range, so I'm expecting it to be stopped out. Now take an example. If I took a trade right here, this would be reasonable if I took a trade right there, because this is a model. And where would I have placed my stop loss? So I'm having this 12 a.m. opening range in proximity, and we have not tapped it yet. So the safest area for my stop loss, mind you, it is big, but I don't care about that, would be half of the 12 a.m. opening range. Because if the market reaches that point and suppose closes above it, I'm not expecting lower prices anymore. Now this would be my stop loss, and if you can see this is a very huge stop loss. A very huge stop loss for someone trading futures. Suppose you're on the mini, this is a very huge stop loss, probably 1,000. Now if you're on a 50k account, you're left with $1,000 to trade with, if it is fresh. Now this would be the ideal stop loss right there, and I don't think you're willing to risk the whole of this move. Now patience, this is where patience pays. You pain with these candles, you feel the pain of missing, and you wait as a sniper in the bush. We're waiting for the market to reach the 12 a.m. opening range, and as you can see, I'm having the bearish 3 drives, 1, 2, and 3. I can execute aggressively at this to commemorate these big moves that I missed. I can execute aggressively at the 3rd drive, which retests in the 12 a.m. opening range, and my stop loss would be either above this or a closure above the 12 of the consequent approachment of 12 a.m. I'm targeting symmetrical price like that. So I support you doing it aggressively on the 3rd drive or to the 2nd drive. So these are some aggressive entries. So this is a high risk short right there. But if I wanted to not to be aggressive, I would wait for the market to drop lower again, closing below this, and this would be my entry. The moment the market closes below, I would take that entry, because the market has been failing to close below these levels. The moment it closes below them, I'm looking at that, my stop loss is above the sweet spot, I'm taking that entry aggressively. So those are some of the aggressive entries. Now looking into 10 a.m. 10 a.m. opens up right here, and remember what I told you, the accumulation, manipulation, distribution. So 10 a.m. drops, and what are we looking at? The 12 a.m. opening range for Thursday's trading right here. So if I'm to draw quadrants on that, this quadrant 2 is very helpful for ICT traders. You should use it. So if I'm to draw quadrants on that, we drop lower aggressively from the new day opening up, and the 10 a.m. leaves a fair value gap right there. So I'm having this as a fair value gap, and this fair value gap would sincerely work as a confirmation if I was to take, because 10 a.m. most of the times brings out a reversal. So if I was to take a reversal at 10 a.m., I would be looking so anxiously at this 10 a.m. opening, the fair value gap that formed at 10 a.m. to be inversed, and on top of that it aligns with the new opening gap. So I would be looking at this to be inversed for me to take my entries. But we have 12 a.m. opening range, and these ranges keep on working through price. You can extend them 5 weeks, month, 2, but your chart will become clogged, and we need something so clean. So we have 10 a.m. giving us a gap. We drop lower into the upper quadrant of this 12 a.m. opening range. We retest into that gap. We drop lower. The body is respecting the consequent approachment of that. We drop lower into the lower quadrant of that. Sorry, the bottom of the 12 a.m. opening range. We retest the lower quadrant one more time. We rally higher into this, close above consequent approachment. These are signs that the power that this fair value gap held is starting to fail. So I'm having a closure right there. We drop back lower, and the body is now are respecting what's on the downside more than what's on the upside. So we even surpass this, and that is a signature for you that now we are going forward for buys. I'm having a suspension block right there, this kind of. We come back higher, then we close above the what? Need the opening gap. So after that closure, I'm looking at what? Bullish entries. Now I'm looking for my entry. I'm having an order block right there at constant rate of this fair value gap. We drop lower into that, and the market comes back again above the opening gap. So if your entry was at that, the market came back, stop loss at that level, and I'm targeting internal range. I'm having a fair value gap right there. If I'm having a bearish fair value gap right here. If that was your target, this is a decent take profit. This is a decent risk to reward ratio. So the market rallies, and this makes 10 points, something like 40 ticks. So we have this move into that fair value gap right there, and going into the launch macro at 11:30. So 11:30 is right there. We manipulate when the moment it opens up, we manipulate lower, coming back into the new opening gap, pushing price higher, and 11, the New York launch session, will go for inefficiencies, number one, and liquidities. So we have this bearish fair value gap right there, but this area is a balanced price range. So everything right here is balanced. The market has no business above this or into this. We expect the market to go away from this, because this has been worked with. It's like a bulb, a lady who has been used, so everyone will be running away from her. So we don't expect the market to have a lot of business right here. So this range, extend this in price, don't forget. So if I'm to mark for this range, this 30 minutes, this is the opening range of 9:30 to 10. Now this was a balanced price range. From 9:30, it's the same as the 12 a.m. opening range, but this is from 9:30 to 10. Now if I'm to draw my field levels on this, you're going to see these things are funny. Like, price action is too fun for me to do. Now if I'm to, let me push this back, So take time and look at those fib levels and how the market reacts at them, and now tell me that ICT is rebranding stuff. Now this is where you take screenshots. This is when you take screenshots. This is when you take screenshots for future reference. Now look at how the market nicely rejects from those specific fib levels. We have this 10 a.m. trading. We trade higher into the lower quadrant of that. Now this is not random. the market pushes back below, respecting the consequent encroachment of this inversion fair value gap. And there is one thing I didn't mark. We have 9:30 opening, so we move, and we have, like, this is the first presentation fair value gap. I wouldn't consider, I think, but this is going to be clogged. So we have an inefficiency right there. You have a breaker. The market rallies into the lower quadrant of that. We consolidate around that, manages to close above it, retests on it one more time, going into consequent encroachment of this range. We drop lower, coming back into the new day opening gap. It references back into that. We come back, this opening range pushes price back into closing below this. So this means we are still dealing in this. Now I want to show you something. I want to pull your eyes to something. If I'm to zoom in at that, this is the new day opening gap high that I talked about. Pushes price back higher into this. Now the market is manipulating. This is a signature that we are still working into this range, the 9:30 to 10 opening range. Now what are these candles right here? Now this is a manipulation move. For those that think we are going to, for the support and resistance traders, those that think that this has been support, we came below that, we closed below this, and we're expecting a move lower. Now I want you to look at, there is no way you're going to get things that work like this. Look at half of this week. I want to talk about something. If we have the market having a lot of business within half of a week, we expect that week to be taken out. But if the market reaches that week and it shows signs of rejection, we expect that market to hold that week to hold the market. Sorry, that was a slip of a tongue. So we come into the upper quadrant, 0.75 right there, premium of this week. We drop, fail to come to main threshold. And where did I say did I tell you we buy from? We buy at what? At discount. Now the market drops to discount of this level below 0.75. And what happens after that? We just rally higher. We do not have the market working around the 0.5, the main threshold, or below it. We leave this untouched, the lower quadrant actually untouched. We remain above the 0.5, and you see the wicks are doing the damage. So if I'm to go back, this is where you listen. This is where you listen and get something to learn from this. So we have the market working into that. As you can see, this pushes price. The market retests one more time, failing to reach the upper quadrant. We rally higher into continued encroachment. We close. Now after we close above this, we are looking for the next quadrant, which is the 0.75 of this range. Would come into 0.75. 0.75 rejects the market. We happen to drop lower and close below half of this. Now this is a signature in price that now the market is going to do what? To continue selling. Now if I'm to draw my fib for the optimal trade entry, I want you to note how the market rallies above and comes back into these fib levels. We have a lot of things that would have been order blocks, but the market doesn't look at that. We come back to the sweet spot, to the tick, we drop lower. Now that is an entry and a good entry. So you see, from this, the market starts running. Now if it was a market maker model, this would be my original consolidation. We have room for retesting the original consolidation, but how far can we retest that original consolidation? Optimal trade entry will drop lower. As a redistribution will drop lower again, going into the new opening gap. We close below that, and this is the launch macro. So after the launch macro, what am I looking at? What timestamp am I looking at? I'm looking at 1 p.m. 1 p.m. opens up. We have the market running away from what? The market is running away from this range. So 1 p.m. opens up, we drop lower. We form a gap right here, but I'm not expecting the market to come back into this gap. We have a volume imbalance at that. If I'm to consider this to that, consequently of which made, I'm having a bearish fair value gap right there. I wouldn't consider this a bearish fair value gap. I would want to call this a breakaway gap. So if I'm to have and I would want this to remain open. Make this even, no, let me make it yellow. Now I'm having a lot of yellow in this chart. Make it green. Having a breakaway gap, I wouldn't expect the market to come back into that, because we are running away from this range which has been holding the market for all this long, the whole launch macro, and we form another fair value gap below the consequent encroachment of this inversion. So I'm having this as my bearish fair value gap. So I'm considering this to be my bearish fair value gap. Now this is my bearish fair value gap. The market drops, closing below the 12 AM opening range. Now as you can see, everything that was holding the market is now being disrespected. Now disrespect this range too. The market comes back higher into this fair value gap for your entry, and coming back into the inversion would drop. If I'm to take this off, I think the purpose of this is done. We drop from this fair value gap, we drop lower, going into 130. Now 130 opens up. This is a new 30-minute candle. We'll manipulate into this range. What do we have here? A high. This high being taken out, this is a data soap entry into this fair value gap. So you need to have, for the data soap entries, you need to have a PDR above buy side that you expect the market to reference to, and after taking away that specific liquidity. So we have this as a bearish fair value gap, and we have a high right there. So this is a data soap entry. Okay, this blue. This is a data soap entry right there. It's funny me putting the data there. So the moment this high is taken out, you execute, coming into the fair value gap, the bearish fair value gap will drop lower. Now if I'm to show you my model, the Fib level, everywhere you execute from, it is there and it works. Now that is hilarious. So from, you see this black candle, this would be my breaker from the low of that. push price, we drop, we close below it, we first fail to close, we drop below it, so I'm expecting the market to come back. This candle fails to retrace into that, the next candle does, 0.618 level, we give you a fair value gap. So this would be my initial entry, this would be my initial entry right there, dropping just like that. This would be my initial entry, taking into this low for the first partials. And remember, in the last lecture we had, this is the new day opening gap for Monday trading. We're going to talk about that. Then we have liquidity. You're going to see we have liquidity that the market takes out. I remember I have a low that I was refreshing to at these levels of 24930 even. So I think I have a low right there in past price action. So you need to be journaling your trades. Now that would be my first entry. Low risk sell, data sub entry, lower. If I'm to put this off, you have, let me show you, we have liquidity right here, it is a low. You have sell side right here, this is sell side, you can see having these lows. These were clean 1 2 3, so I'm having these lows, taking these right there as my sell side. I expected the market to take that out. It was 2 3, not 29, 2 3, 230 even, yeah. So I'm looking at that, 230 even. Okay. So data swap entry, we have breaker with the wick. I'm not considering the breaker, I'm considering the wick. Isn't this beautiful? Wow. There's price action 1 on 1. So we have that as my breaker. I'm not considering the breaker itself, I'm considering the wick. We have this, the market comes to mean threshold, we drop lower. We do not have a move coming back into mean threshold or creating a high, so we are creating lower lows, and these highs are just continuing to drop lower. So this is showing you that a big move is coming, and this is the market preparing to go through the Monday new day opening gap that I talked about in the previous lecture. So we drop lower, close below this. These candles right here is the market preparing or building momentum or fuel to surpass this level, because this was a strong level, and we drop below that, we inverse it. So everything that ICT taught has an inversion feature to it, so we inverse that just like that. I wouldn't consider this an inversion feature, I want it to have an orange feature. So we drop, we come back into that, wow, beautiful, then we drop lower. So where did this move start? The move that takes out this, that new day opening up from the high to that, wow, it's pure price action at its finest. We have from, where did I put it at? No, just there. We have from this high, you see, this is the negative 0.25. This is my point of liquidity, the new day opening up Monday. From this high that started this move, initiated this move to my draw liquidity, how far can the market go beyond it? The negative 0.25. I have it right there. It smashed. After it smashed, we drop lower into sell side. Price is jagged and we rally back into the range. So this random. This is so beautiful. This is beautiful price action. So we have the inversion, drops lower, coming for sell side, after we take out sell side, we rally higher. Note that we do not inverse this fair value gap. That's why you have a strong move lower. If I'm to do this, you have ES also did not take out that low, so we do not have SMT, and this is accumulation into the day. So 2 p.m. trading opens up, and after 2 p.m. you know what I'm looking for. 2 p.m. opens up, I'm looking for accumulation, manipulation, and distribution. So the whole of this move is accumulation of orders. Accumulation, if I'm to consider this as my this range right here, not this candle, of this consolidation market, we're testing into that. So me considering this as my accumulation. Let me make this as a APR. That is a balanced price range. Market works in this. We drop lower. This is my manipulation. This works every single time. I have my manipulation, rally higher into that, have a fair value gap right there, which is a bullish fair value gap. After the market structure shift, you remember you don't need the market structure shift to close above this high. Have a market structure shift to have a bullish fair value gap into this balance, coming back into this balance price range. Then we rally higher. We have these highs as buy side, and this high is here. So the market takes that out, drop lower into this, the opening up, we accumulate throughout the session into the close. So now this is something that is so beautiful. And let me see, it's so beautiful, wow. Guys, isn't this beautiful? I would really love this. I'm so in love with this. Okay, so I think that is it. That was Friday's trading from the pre-session going into the lunch macro, then the PM session. So that is it. Thank you for watching. Thumbs up. Don't forget to subscribe. Thank you.